a lot of you on the list. I'm very glad to see you here, and of course welcome to all of you from throughout the country. It's a sleepy evening in August, so we were anticipating a lower turnout. I'm getting a question from Bob. How many on the call tonight? Bob, I'll give you that number in about 5 minutes or so if you give me just a chance, okay? And Mark, I'll turn it over to you now.
Well, thanks, Ken, and welcome everybody to the August edition or session of the Roundtable. I'm joined here tonight by Ken Kavula, who you just heard speaking and kicking people around in the pre-session. Hugh McManus was supposed to be here, but he's in the air somewhere between San Francisco and Los Angeles. So, again, he is out there, people. He loves all of you, but just has not been able to coordinate his travel here lately. And we're also joined tonight by one of our guest knights, Matt Spielman. Matt has been with us more than once, at least three, maybe a fourth time, if I recall. I know he's got a couple very well-performing selections out there. So welcome, Matt, and look forward to your participation here tonight.
Thanks, Mark.
All right, so let's go ahead and get underway. I did kind of entitle this Perpetual Tug of War. That was kind of the theme of our weekly message, that this is kind of the time of year back to school when the analysts seem to be ratcheting expectations up and down. Their forecasts typically tend to kind of wane or subside as the year goes by, and then we ratchet into the next year and optimism kicks back in. It's a never-ending battle. And the only solution that we can offer to all of us in this community is to kind of smooth things out and pay more attention to the longer-term trends. And we'll spend some time talking about that tonight, some brief comments about our smoothie portfolio commentary. Ken will spend a few minutes talking about one of his favorite areas, the 100 fastest-growing companies that just came out in Fortune magazine. Correct, Ken?
Absolutely. I just got my new Fortune yesterday, and I've been playing with that list for the last 24 hours now.
So we'll give you a glimpse of it, and I'm sure we'll be featuring even more stuff as we go. Quick reminder, if you want to be added to a reminder list about this coming, I know that Natalie, Ken's significantly better other half, her email address is down there, nkavula1@comcast.net. Just send her a note, and she'll send you a couple of reminders as the month goes by about when this session comes on. If you have any questions, you can write to me at that email address there. We'll get the legalese taken care of here. Again, this is just our quick reminder that we've been doing this now for a little over 4 years. We're starting our 5th year. This is for educational purposes. We're here to demonstrate a process or a methodology for successful long-term investing. The analysis and selection and discovery of stocks that individuals and clubs can pursue investing in. Do your own homework, and again, no investment recommendation is intended. Here's our standing agenda. Again, welcome to all of you. Extra big welcome to the Michigan folks that join us on a regular basis, and a big welcome hug to those of you who may be joining us for the first time. This is kind of our standing agenda. We'll talk a little bit about where we've been. Try not to spend too much time on that. Typically, we might have a stock on the hot seat, but we really don't tonight. We'll take a quick look at that. We'll go into 4 stock selections. Hugh McManus, who, like I said, he's not able to join us tonight, so we'll take a quick look at his slides. He's bringing a repeat selection of DEER, ticker symbol DE. Ken is going to go into an area I have not seen him in too much in the past with Las Vegas Sands, ticker symbol LVS. I'm going to do a repeat selection of Maximus, MMS, and Matt Spielman has what I think is an intriguing and a neat stock to study, a little bit torturous, if I can use that word, when it comes to the study, because this is an exciting, promising, emerging company that's kind of a tiger by the tail. So it's a good study, and look forward to doing that. And again, we'll poll all of you to see of the 4 which would be your favorite at the end of the evening. Okay, let's just do a quick reminder. We've been asked to come here with a single idea that it's kind of bubbling towards the top of our radar screens, and I think all of us have done that. We do file any selection that is made either by the participants here or by the audience into a tracking portfolio. We keep track of the performance of that portfolio over time. we really would like to see that collection of stocks outperform the Wilshire 5000 by 5 percentage points. It's 500 basis points, 5 percentage points over the long term. And we'll take a look at how we're doing so far. And we'd also like to see, 3 out of 5 or 3 out of every 4 selections actually outperform the market. We don't obsess over that, but it's more fun when we pick the ones that beat the market as we're tracking them. Here's a quick look at the portfolio. This is the stocks that have been chosen most frequently by the participants here over the last 4 years. Again, to decode this chart, these are the stocks, again, that have been chosen the most frequently. So in the case of Cognizant Technology up here at the top, you can see that Cognizant has actually been chosen 9 times by this legend down at the bottom. Every time the stock is selected by any of the participants, including the audience, let me change my pen color to make it a little bit easier to see. Anytime that we do that, we invest $1,000 into that company. So Cognizant Technology has had $9,000 invested into it, and its current value, I believe that's yesterday's close, is $12,682. So that one's actually been a pretty good one for us. It's been a favorite. It's been selected by many different attendees. Number of companies on here that are community favorites, a few that are a little bit less in the mainstream. Companies like BioReference Labs is, I believe, the 3rd most widely followed company by Manifest Investing subscribers. And you can see it's actually done pretty well, although it's a bit of a roller coaster, as people were pointing out in the pre-session. One that people might want to take a look at. Like I said, there will probably be some follow-up discussion after this evening in the Manifest forum about BioReference. I believe it went from $33 a share to $29 a share today. So that's the type of roller coaster you sometimes get into with some of these smaller companies. Any comments on any of the companies there that reach out and grab either one of you gentlemen?
I think it's a pretty nice portfolio if you only choose the top 10 or 12 of them. There's some great companies there. They're not all buys right now, but there's some really nice up, straight, and parallel kinds of examples for people to take a look at.
Yeah, there's some good core companies there, and some companies like Mesa Labs Universal Display, which we've only featured a couple of times. It's up to almost $4,000 now. Cool stuff.
Yeah, that's only been chosen 3 times, so that's nice.
Rolling along pretty good. All right, here's a look at how we've been doing month to month. And again, we don't obsess too much over this, so we almost close our eyes. Our long-term goal is to get up somewhere around that red line. We have hit a bit of a slump over the last several months, but the overall trend we still believe is quite good. Overall accuracy somewhere in that 50% range. But the number we'd really like to get at and live at is closer to that 5 percentage point goal. And again, that's got its legacy in the modern investment club movement, that objective of over the very long term beating the market by 5 percentage points. The 15% that you hear chanted in some investment club meetings is literally just 5 percentage points above a 10% long-term return on stocks in general. So again, we basically use that as kind of a moving target, but the target is always to beat it by 5 percentage points over the long term. So with that, what I thought we might do is just spend a couple of minutes talking about some companies over the years and maybe some quick screening. In our August newsletter, which came out a few days ago, I talked about this book, which is actually written by one of the volunteers out in the San Francisco area. I didn't realize this until I'd done a little more reading about Linda. Linda Mead published this book, actually working in kind of a co-author phase with Susie Orman back several years ago, back in the 2002 time frame. And she basically made the point that if you found, again, as Ken was just saying, a bunch of core companies up straight and parallel, for the most part, if you bought in and tried to get them when they were at an attractive price or an elevated return, according to your studies over time, you could probably do pretty well. And what's kind of interesting with this is I think this list surprises some people, especially over the last 10 years when things have been kind of sluggish. Specifically, in the case of the S&P 500, I don't know why my pen color switched back, but we'll try it one more time. The S&P 500 over the last 10 years, the period since this book was published, has gone up at 6.6%. What's kind of fascinating to me is of the 10 companies, 7 of them outperformed the S&P 500. A couple of them didn't do too badly. One of them disappeared from the planet and came back. We don't talk about that one too much in the Detroit area. But again, taken as a collective, taken as, all 10 companies, including the full loss on General Motors, the $1,000 invested 10 years ago has actually gained at 8.7%, beating the market by a little over 2%. Again, kind of approaching or in the same neighborhood as that 5 percentage point advantage to the market shown in that previous slide. Well, last week we were having some fun with kind of an interesting moment in time. Google came public 10 years ago and celebrated the 10th anniversary of its initial public offering last week. And somebody made the comment that over that 10-year period, there were only 10 companies in the S&P 500 that had outperformed Google. So we dug in a little bit deeper and found that Google had actually returned, as you see right here, 28% per year over the last 10 years. So you're literally we're looking for 10 companies that had beat that over the last 10 years. That ain't easy. And the list of companies is there before you. We actually had some fun with people trying to find these by guessing at them and then checking the performance, and almost had a bit of a contest going on in the manifest form. But it's a really interesting list. And what I find most interesting about this is right down the middle here. Every single one of these is a NASDAQ stock. I mean, just think about that. You hear us preach, and you probably hear Ken preach here in a minute, about how important it is to have not just the core holdings featured by Linda Mead, but the combination of core and smaller, faster-growing companies to give you a sufficient amount of growth in your portfolio. Well, these certainly would have provided a boost to the overall portfolio growth going back over the last 10 years or so. Some of these are turbocharged in that regard. So again, it's just a real reminder that, yeah, I have the core companies, but go out there and find some exciting, smaller companies, promising, that are high quality, and the blend of the two is probably not such a bad idea. And that's what kind of gave us the theme of this smoothie, late summer smoothie. Here's 10 companies, or actually 20 companies now, 10 of which that are from the NASDAQ, 10 of which that are off of the New York Stock Exchange. But overall, kind of an interesting field of opportunity. And some of them are actually better in terms of return forecast. This is all value line data. Kind of an interesting portfolio. We actually put this together as a portfolio at Manifest called the Smoothie 20. And we're just going to watch it and see what happens with this group of companies, and hope to see market outperformance over the next few years. So again, just that reminder, I mean, the 40 refers to the Manifest 40, which is a collection of predominantly core stocks with a few others thrown in, but a blend of faster growing companies along with those core community favorites is a pretty good idea over the long term. So with that, Ken, why don't you take it away and just kind of talk a little bit about some of the companies you're seeing in the fortune list as you dig in and do your preliminary work.
Well, what I did, Mark, was I took that list, and I've already got some folks asking me where you can find this list if you don't get Fortune magazine. So if you could throw it to me real quick, Mark,
Sure.
the screen, I'll show folks exactly where that list can be accessed.
Should be coming your way now, Ken.
Here it comes, and I've gone to, oddly enough, the ticker fortune.com, because this is a fortune list. This is not the list of the 100 best small companies. That list comes out around Halloween, and that's a Forbes list. But this 100 fastest growing companies is from Fortune magazine. And if you go to the home page, that's where I am. I didn't have to register. I didn't have to give them any names or credit cards or anything. And you just scroll down just a little bit, you'll see off here to the right that there's a category called rankings. And here's the 100 fastest growing companies. If you click on that, and I'm clicking right now, and you come up with a list. Questcor Pharmaceuticals is right on top. There's some articles. They tell you their methodology. I want everybody to know that Questcor Pharmaceuticals has been bought by Mallinckrodt. That's another drug company, so they're no longer a company on their own. But you can get this whole list right here, and if I scroll down, you just see that that list just keeps on a going and a going and a going, so you can get 100 great ideas. What I did, and now Mark, you can take that screen back if you want to.
Okay.
What I did was created a dashboard for all 100 companies. Mark was very busy today and found that we were not covering, I don't know, 10 or a dozen of these companies in Manifest. So he took the time today to do the analysis and get them covered. I think all 100 companies except one are now being covered by Manifest. So you can go in and take a look. And here is that list sorted by par values. You can pretty well look at the companies that I might be looking at. At my club meeting last night, we assigned Noah Holdings to one of the partners. We have no idea what this company does or anything about it, but we did assign it to a partner to research and bring back some preliminary information. We're familiar with Solar Winds from last year's Forbes list. We're familiar with Nu Skin. We own Priceline. OLED is certainly familiar to the folks in the roundtable here, where we talked about it a number of times. Portfolio Recovery, another very familiar company. Here's one that nobody knew about, so we assigned it to a partner. And we got down to Las Vegas Sands, and I decided that I would do some research on that particular company. So that was my assignment.
Does that include going out there to check it out, or?
Not yet, but maybe. When you find out where it is, it's a pretty good hike where they do most of their business. But we'll talk about that in a few minutes.
I know. If you need a stowaway, let me know. I saw the places. Wait till you guys see this.
Here were another couple of companies. We knew a little bit about Yandex, but not much. We knew nothing about Melco Crown. So that's the way we dealt with this dashboard here. We basically just went down looking for high quality and then par values, and I think we stopped looking on the list at par values around 9%. So 9% on up to the very top one right there. And what we're doing, folks, is basically just looking for some good ideas. Once we find some really good ideas from the list, we'll find a couple of peers or competitors to study right along with the company, and that should lead us to some great purchases in the next 6 months or so. This list always is interesting. And I always get at least 2 good ideas from a list of 100. So I'm hoping for at least 2 great ideas or 1 really great idea. That's all you need. This is where I first discovered Priceline lots of years ago, maybe 4, maybe 5 years ago now. And this has been a company that's been very, very good to my club and very, very good to my wife and myself and our own personal portfolios. I don't know, we're getting some questions. Maybe I can answer a few of the questions right there.
Why don't you grab some of those, and I'll take the opportunity just to launch a caveat emptor, and Ken always does this when he makes the presentations about the smaller companies. You're going to find several things involved here. Some of these are Chinese. Some of these are involved in oil and gas, including things like fracking, so some of them can be quite volatile. Some of them are covered by relatively small numbers or few number of analysts, so they can be quite volatile from a research side of things. So just, again, it can be a minefield. We like to remind people of that, so be careful as you tiptoe in. But again, it can be a place where you discover some pretty interesting opportunities too.
Mark, we're getting a number of questions about whether they can access this particular dashboard. Are we going to make the dashboard with all 100 available? Do you want to do that?
I don't know. Do you guys want us to do that? Probably do, huh? Let me see if I can jump out. Hold on. Let me show you where it's at. If you go to Manifest Investing, and let me just go to the home page. And again, if anybody is not a Manifest subscriber, but you'd like to check some of this stuff out, go ahead and send me a note, and I'll send you the public link to this this dashboard. But I believe it's here, Ken. Fortune. If you look under Fortune, if it's not, it will be. Here's last year's list. Oh, I may have actually shut it down just for while I was working on it, but it'll be in this place where it'll say Fortune 2014 fastest growing companies, and you can just click on it and check it out. So it'll be there as a published dashboard.
We'll have it up for you tomorrow so you can access it and play with it. It's obviously nothing that is secret, so we're glad that you can take a look at it and perhaps share it. Okay.
And when Ken gets going here in a few minutes, he is going to be talking about Las Vegas Sands, so it's right there along with some of the other community favorites. So let's just go ahead and, again, I just want with this one last quick reminder to show some of the companies that are in the Manifest 40. For those of you that aren't familiar with it, it's a tracking portfolio of the most widely followed companies by our community of investors. And we kind of do the same thing for this that we do with the roundtable tracking portfolio. When a company shows up on a number of dashboards that qualifies it for the top 40, we basically take and invest $100 into it. So when Apple actually appeared to be, a bunch of you guys out there were accumulating Apple about 3.5 years ago. At that time, it showed up, and it's actually become our #1 most widely followed company now. But $100 into Apple a little over 3 years ago is now worth $406.89. Same thing is true. Cognizant is one of the charter companies going back about 8 years now. 8 years, $100 has become $500 in Cognizant. So again, from top to bottom, these are some of the companies up towards the top of this list that are, we think it's important in the spirit of the Modern Investment Club movement, investing with your friends. These are 40 stocks that people who invest of like-minded philosophy have found interesting and actually are probably in at or nearby zones today, as you can see at the top of this chart. So again, it's the smoothie message of blending in a bunch of good core holdings with very high quality ratings to protect you during recessions and corrections and all that kind of nasty stuff, but at the same time being willing to step out and look at some of the companies like Ken was just talking about, the emerging, exciting, promising companies. And that blend can really serve you well as an investor over time. Are we doing okay on the questions log, Ken?
I think we are, Mark. We have a number of questions that aren't related to what we're talking about right now, so I'll hold them till the end. But why don't we continue on our agenda?
Okay, let's go ahead. I'll go ahead and pinch hit for you for a couple of minutes. This is a repeat selection. It's also a company that's known to everybody here, the Deere Company, Great Illinois Company. It is a company that is subject to economic sensitivity, so anytime the economy suffers, you're going to see a downdraft in the company. You can see earnings and sales took a hit back during the Great Recession of 2008, 2009, so this company does have cyclicality. And but over the long term, the bumps and the roller coaster humps and bumps still have an upward growth pattern, so it is still a growth cyclical. You can see that the analysts who follow the company have kind of a pessimistic outlook for 2015. And that's not as much related to the United States as just a little bit of pessimism still hanging in there about recovery from the global recession. So again, this is also, to me, it's a great example of that stock price really does follow earnings. And you can certainly see it here that these black bars, the stock prices, followed the earnings down, followed the earnings up. So if these two expectations from the analysts are true for the next couple of years, again, we could see quite a flat spot. And again, in the Hugh McManus world of investing, that is simply an opportunity. He literally sees that as an opportunity to accumulate this company in this flat spot or this trough, waiting for that next surge when the global recession ends. That is literally how he thinks, and some of us have trouble wrapping our arms around that. I'm bad at this stuff, but he does it well. Here's a quick look at his way of finding these companies. He literally takes a look at the spread between the 52-week high and low, and he keeps track of a set of favorite companies, many of which he already owns, and then he will accumulate companies towards the top. Here's his explanation for what he does. He basically takes a look at the company, thinks of this ladder. He always wants to buy down towards the bottom of the ladder when a company is approaching or is near its 52-week low. He says he likes to look down there because he's afraid of heights. Well, too bad for him. He's in an airplane right now. So that's what he looks at. And then if you actually tack on part of that equation, you find companies that are trading near their 52-week lows. Taking a look at the par, again, you can search on the return forecast and kind of watch for candidates. And that is literally how he decides to accumulate companies within his existing holdings. You can see that Deere has floated towards the top of this pack. So his outlook for Deere is still pretty good over the long term. We would share that opinion, and it's trading closer to its 52-week low than many companies out there. So again, he's always shopping at the top of this list. Says he likes to shop in bad neighborhoods. Best value almost always comes with the most risk. So again, I'm not going to go too much into the details of Deere. It's a company that is certainly very well established. It's going to be economically sensitive. We know that. The company's going to, at least there's a threat that the company's going to stay in a flat spot for a while. He did want to take a moment to brag about his Intermune, which is up 100% in the last 4 months. That's this one down here. In fact, I think he's got a slide here that's, yeah, ka-ching. He found that one using the same method. So again, Illinois company, no stranger to any of us. It's number 85 on the Fortune 500. There's certainly no shame in a $38 billion company growing at 6 or 7%, and they make some really good tractors. I would sing some country music song for you here, but you don't want to hear that. So good, a lot of good characteristics. Again, as Mr. McManus says, highly cyclical business. You can't ignore the fact that it's going to be impacted by recessions, but again, over the long term, something that you might want to pay some attention to. Quick look at the stock selection guide. You can see up straight and parallel, but with speed bumps, big speed bumps in some cases. Again, you can see very decent characteristics, especially for a company in a challenging and operating environment as this one. The overall trend is up on profitability, and some pretty decent looking characteristics. In fact, for a company as bouncy as this company is by design, the PE history that you see in section 3 is actually pretty steady. Not too much variation up or down, which is really kind of rare, even for a steady growth cyclical. So you can see that he gets a company that's in a pretty decent position in the stock selection zone. It's a little bit outside the zone, but here's a quick look at the manifest investing situation. A sales growth forecast of about 5.6%, call it 6%. Fairly steady profit margins over time, call it 9%. A PE ratio, not unusual for a growth cyclical, in the low teens. And those three characteristics basically add up to a decent overall return forecast. Keep in mind, the average stock right now is at about 6%. So that's why Hugh sees it as, again, it's a repeat selection, and his selection for the tracking portfolio for this evening. So let's just go ahead and close out and switch gears and take a look at Las Vegas Sands.
Hey, can you throw that screen back to me then, Mark?
Coming your way. You should have it.
So we're going to talk about a kind of company that I don't normally get involved with very much. I know that there will be some people out there that will automatically discount this company and cross it off their list because it's involved with the sin trade, so-called. Same for stocks like Altria, for example, cigarettes, and some of the liquor stocks, Brown-Forman, for example. But if you don't have any objections to gambling, and if you think that there's money to be made in gambling, then you might want to take a look at Las Vegas Sands. They're one of the largest operators of casinos in the world, and you can see some pictures of their casinos around the top right there. A great trivia question that we used to ask when I was coaching Quiz Bowl at the high school level with our high school kids was, what's the largest office building in the world? And the answer used to be the Pentagon. Well, that's not true anymore. The largest building in the world with rooms and offices is now the Venetian complex in Las Vegas. That's the largest one in the United States. And it's a huge, huge complex of rooms and offices and exhibit space and all kinds of things, anyway, larger than the Pentagon. You also can see that they have considerable business in Macau, Singapore, and they're looking to also put some business into Pennsylvania, right down there in Bethlehem, Pennsylvania. Let's go through some facts real quickly. This company was founded by Sheldon Adelson, and that's a big name in Las Vegas. He's still the CEO and the chairman of the board for Las Vegas Sands. His businesses date back to the mid-70s. In 1979, he founded a company that put on a giant show, which is still going today, called Comdex. And basically, it was a giant electronics computer show in Las Vegas, and it draws thousands and thousands of people. Like I said, the show is still being held on an annual basis today. In 1989, he purchased the old Sands Hotel, one of the original hotels in the Las Vegas area. And in 1995, when the Sands was having some issues, Adelson sold the Comdex company for $0.8 billion. That's $800 million. And then in 1996, he decided that he wasn't going to be putting any more money into the Sands, so he imploded the Sands Hotel. You can still go to the internet and find pictures of that hotel being imploded, coming down. And he began construction on a hotel that everybody said was not going to work in Las Vegas. It was a large themed hotel called the Venetian, and the focus in the Venetian was on conventions and on purchasing, on malls and stores. Up to that point, the hotel rooms in Las Vegas were generally very small, with the idea that if the hotel rooms were small and not too luxurious, that would push people down to the casinos to do more gambling. Adelman said, we're going to open this hotel, and not only are we going to focus on convention business like Comdex, but we're also going to focus on large, luxurious rooms in our hotels, and we're going to attract a lot of business when we do that. It was a huge gamble, and he succeeded in making that happen. He was one of the first entrepreneurs to move to China, noting that China was a huge audience for gambling. China allows gambling in only one place in the entire country, and that's on the former Portuguese colony of Macau. Macau is across the water from Hong Kong, down on the coast, and Adelman opened the first property in Macau in 2004. He's one of 6 vendors that now have licenses to run casinos in Macau. Now, Macau is a very, very small amount of land. It's only 11 square miles. It's only about 1/3 the size of Hong Kong. And Adelman decided that the only way to increase the number of hotels and the amount of gambling going on and the convention business was to create more land. Macau originally had a couple of islands that were very close together, and what Adelman basically did was he spearheaded the creation of something called the Cotai Strip, which basically filled in the water between two islands, sinking piers into the bedrock and creating some gigantic hotels, places for conventions, etc. He opened the Venetian Macau in 2007. It's the largest casino in the world. In 2009, he moved to Bethlehem, Pennsylvania, and opened up the Sands Casino Resort and moved the center of gambling from New Jersey to Pennsylvania in one fell swoop. He opened up in Singapore. Singapore is an independent country from China, and he opened up in 2010 the Marina Bay Sands. He's one of only 2 companies that are licensed to run gambling in Singapore. And then in Macau, back to Macau again, he opened the Sands Cotai Central in 2012, attracting 3 of the largest hotel chains in the world, Hilton, Sheraton, and the Holiday Inn. Now, there's been a lot made that Las Vegas Sands is having some issues keeping the amount of high rollers. And so I dealt a little bit into this whole question of, does the casino need high rollers to continue operating at high profit margins? There's a great presentation on their website. It's about 90 or 100 slides. You might want to read it very carefully. I've chosen just a few of those slides to try to explain to you what the business model for this company is. First of all, it's doing more than 80% of its business, this company is, in Macau. So I'm going to focus on what happens in Macau. If you look at the left-hand side of this slide, you see the blue bar. That's the high rollers and what kind of revenue the casino gets from those high rollers. And the gold bar are the mass operators, the masses that come in, the everyday normal kind of people like you and like me. Well, when you move that over to the right side of the slide, you'll notice that that smaller amount of mass business produces almost 2/3 of the profit for the company. They get 70% of their profit from the 37% of mass business from the tables and slots. The high rollers, which is 63% of the revenue, only accounts for 30% of the actual profit that's going on. So the strategy for this company is not to attract the high rollers. It's not to discourage them by any means, but the strategy is to increase the number of masses moving to the tables. The Macau visitor has changed drastically. It used to be a place where the James Bonds of the world were attracted, and today, with more efficient and affordable transportation, with additional tourist attractions, with more hotel rooms, and especially with a rapidly expanding middle class, the Macau visitor is moving away from this high roller status, and they're staying longer, and they're spending more on non-gambling things like dining, retail, and entertainment. There's 5 trends that's going to continue pushing this growth. First of all, in 2020, there's an expectation of 200 million Chinese traveling outside of China. Compare that to less than 100 million in 2013. The connectivity between the rest of China and the Macau area is meaningfully expanding. People are staying longer when they come to Macau, and an island directly adjacent to Macau called Henquin Island is being developed as an entertainment complex and tourist destination. On top of that, by 2018, there's going to be 13,000 new hotel rooms. Here we're looking at the outbound travel from China. The blue dotted line, or the blue line, shows us the number of tourists coming from China with some projections on that blue line. The red line shows us what they're spending in U.S. dollars in billions. So you can see that more Chinese are leaving the country, and they're spending a lot more money as well. You can see that the market, or the number of Chinese leaving the country, still only represents about 6% of the population. Compare that to about 45% of the Taiwanese population that travels abroad. Here's the rail map, these high-speed rails that are connecting all parts of China, and that rail system is drawing people into the Macau area. Macau is down here near Hong Kong, and I'm going to move my cursor around it. Macau is right here and across the water from Hong Kong, and the rail trains are making it very easy to get there. Here's a great statistic. 1 billion people are within 3 hours of Macau, and 3 billion people are within 5 hours of Macau. So there's a huge, huge number of folks they can draw on for their business. You can see that the growth of the day trip visitors to Macau is very substantial, very, very robust. And the overnighters to Macau is also growing at a great number for a very large amount of people. Here's this Hengqin Island, which is going to be turned into an entertainment complex, and it's right adjacent to Macau, so people can come here with their families. They can visit Hengqin Island. They can gamble in Macau. Macau will have most of the housing, and the island will have many of the attractions. You can see right here that Las Vegas Sands has more than twice as many hotel rooms as the next largest company. And again, remember, there's only 6 companies licensed to operate in Macau, in China here. So the Las Vegas Sands currently has much more than twice the number of the next highest, and if we put potential growth on there, we'll see that the number of rooms operated by Las Vegas Sands is going to be approaching 3-to-1 over their next biggest competitor, so they're certainly going to have the place to put all these people. We're looking at very consistent compounded annual growth rates for the mass table and gross gaming revenues, compounding at 28% year over year since 2005. We can see the growth in the mass tables. Remember, that's where the profit is coming from, and the growth in the VIP tables. Both segments are growing, but we're getting most of the profit from the mass tables, the mass gaming establishments. Here's another way to break that down. The VIPs from the second quarter 2013 to the trailing 12 months on second quarter 2014 have reduced. The mass tables have increased, however, by just about the same amount, and that means profit margins will be really on the increase for this company. Here's just a picture showing the different types of things that the company is focusing on. One of their biggest focuses is shopping. They find that if they can get the Chinese to Macau, the middle-class Chinese, then they do a lot of shopping in some of these very high-end name brand stores that are in their particular a hotel. This is an artist's rendering of what the Parisian will look like in Macau, and the Parisian is supposed to cater exclusively to the mass gamer. If you're a VIP, you will not be focusing on going to the Parisian. It's just not your kind of hotel. They're going to spend $2.7 billion on the Parisian. You can see how close all the buildings are in this very small footprint in this former Portuguese colony. And the plans are for Las Vegas Sands to move their business very slowly to Japan, who is now considering opening up some gambling sites in the country, South Korea, and to Vietnam. Certainly, as a global leader in integrated resort development, Las Vegas Sands is one of the few companies in the world that will be able to set up a powerful convention-based business model and also set up integrated resort development opportunities. It'll be very interesting to watch how the governments of Japan, South Korea, and Vietnam deal with granting the licenses going forward for gambling. Let me move real quickly now to an SSG for no, that's not where I want to go. I want to go to the manifest investing picture for, and it's blacking. I don't understand why. Let's see if I can
try a refresh maybe.
There we go. And I'm getting a very high quality company with a par that is very robust. The par at 17 I think is doable. If this were 27 I'd have some questions, but a very high quality company. And what I love to see is this graph right down here at the bottom. This is one of the reasons why I'm so high on this company right now and why I'm going to give a very positive report to my own investment club. Notice the quality line. That's the blue one, and maybe I can erase some of these other things here just to show you the blue line. That blue line is quality, and the last data point on here, which I can hover over, is the July quality at 81.2. Notice that the August quality is at 90, so the next data point is going to move up here where the point of my cursor is right now. I love to grab companies where the quality is basically trending up and trending up quite dramatically. That means that things financially for the company and in relative sales, relative profitability are really all moving in the right direction. So I love to grab a company that looks like that. I'm going to go back now and look at my toolkit real quickly. Up, straight, and parallel since the recession, and you would expect this company to be extremely sensitive to the recession. In fact, Adelson had to lend the company $1 billion in 2008 to keep the company afloat. But it turned out to be a great investment, as you can see it moving out of the recession with significant growth going on. My SSG shows a par value of about 16. I think Mark's par value was about 17. So I'm certainly comfortable with everything that's going on with the company. And so I'm going to add a holding in Las Vegas Sands to our tracking portfolio and kind of watch it and see how it does in the next couple of years.
Well, cool. Thanks, Ken. I believe that Wendy and I are staying at the Sands or the Venetian come January for the Consumer Electronics Show, so we'll get to check out some of this stuff in the field. Let me go ahead and switch the screen back to me. I assume that's okay with you, sir?
Absolutely.
And then we'll just go ahead and move on. Any questions at this point that we need to field, or?
No, I think we're all set on questions yet at this point, Mark. Okay. So let's go on to the next company, okay?
All right, I'm going to bring Maximus here tonight, ticker symbol MMS. It is a repeat selection, so we'll be taking a look at one that we covered here a couple of months ago. But I also wanted to share one of the reasons that I did bring it. And what I put together here is basically took the round table and ranked it by manifest rank, which is a combination of the return forecast, the par, and the quality. So you should see, and you do here, you should see the stronger characteristics up at the top of the chart with respect to both par and quality for the companies. So those are actually both behaving pretty well in combination from top to bottom. And again, what I did is I took companies that are already in the roundtable tracking portfolio. You'll see that Ken's nomination for tonight is here, as is Hugh's. So, and so is Matt's. Matt's going to be talking about Altisource here in a minute. But just kind of looking down the list, looking for a company that we may have covered that still continues to have fairly strong characteristics. I mean, one of the things that Ken didn't mention was that Las Vegas Sands has had kind of a speed bump in the stock price. There were some concerns about transaction processing or something, and Maximus has also had some type of unusual drop in price here in the last few days, kind of mirroring drops that we saw in companies like Cognizant and Infosys Tech. And again, I just think it's this persistent or nagging tendency of being worried about the overall world economy, especially these companies that have international operations. So in the case of Maximus, it does show up here fourth on the list with a decent projected return in the mid-teens, relatively high quality ranking. But Value Line agrees that it's a double-digit return forecast. That's the low total return forecast. And S&P checks in with, yeah, it could be a little bit undervalued. Anytime a price to fair value ratio is less than 100, it's potentially on sale. So all of those characteristics back up Maximus pretty well. Here's a look at the sales and earnings over the last few years, including a couple years of analyst estimates and then the Value Line estimates out here on the end. For those of you that aren't familiar with Maximus, again, a reminder, it was featured in June 2014, so Ken gave it a pretty good go-over. You can also go to the Maximus website. Whoa, I just lost my screen. Is that just me?
No, it's everything. You're going to have to refresh it, Mark.
Yikes.
You're back.
Has that been happening a lot here lately?
No, I haven't seen it before. I don't know why why it's happening.
Interesting. Okay. Well, let's hope that it doesn't misbehave too much. So what you're looking at here is the visual analysis for. Let me switch back to the pen here. For Maximus, again, with your reminder that we featured it a couple of months ago. And for those of you that aren't familiar with the company, they do provide services to mostly to government agencies. It is a company like Cognizant, but they've kind of found a niche in the healthcare consulting. And you can see the buzzwords there, the Medicaids, the Medicares, all the exchange type stuff. They have actually they've landed a number of contracts related to the healthcare reform stuff going on right now. And that somewhat explains this uptick in sales from the longer term trend. So again, that may be a bit of a bump or a step change that may not persist, and that's kind of what you see here. The Value Line analyst is not expecting it to follow a trend, but to just kind of flatten out. But again, at a higher level, earnings have behaved pretty well. They do business outside the United States, Canada, the United Kingdom, a little bit of work over in the Middle East. So it's not just a United States play. It is healthcare, information technology on a worldwide basis. The other two major milestones that we like to keep a track on, Maximus has a very strong record as far as their management report card when it comes to profitability. You can see the net margin over time. It's projected to take a little bit of a hit. That may have something to do with kind of that probably almost unexpected influx of business that they've had here in the last year or so from the current healthcare reform efforts. You see the PE ratios have ranged in the upper teens, perhaps lower 20s, so it's not terribly unusual to have a PE expectation in the high teens. You can see the Value Line is projecting that the longer-term profitability will return to historical norms. So again, this part of the features that we are building out for you will have something that will resemble this. It is a work in progress, but the capability of coming and bringing your own estimates for study purposes side by side with the analyst consensus. Again, we build these numbers based on Value Line, Standard & Poor's, Morningstar, and others. And the bottom line for all of that is that is a return forecast of about 16%. Side by side with a personal study, assuming about the same amount of sales. I think I took that straight off of Finance Yahoo, but a 15% top-line growth rate along with a net margin, again, fairly consistent with historical levels, certainly backed up by that graph we just saw. I kind of made the assumption, what if they don't buy back the shares that everybody's assuming? Under those conditions, you're talking about $4 in earnings per share 5 years out versus $4.50. Left the PE the same, but again, side by side, I can live with anything in that 14 to 16% forecast range based on the assumptions that you see here. So that's pretty strong stuff, again, considering that the average stock is down around 6% right now. So with that, I'm going to go ahead and renominate, add Maximus to the tracking portfolio for the roundtable. Any questions or comments, or can we move on to Matt?
Well, Mark, just a real quick one. We're getting a question about the difference on the Eagle between the raw score where it's tallied and the percentile score for quality up on top. Maybe you could bring up that sheet real quickly and we can show folks what I'm talking about.
I'm not sure which sheet we would go to, Ken.
Just Maximus, the Maximus stock sheet for Manifest.
Okay, hold on.
And then the question, Mark, and it was for Las Vegas Sands, but it's the same for any stock. The question is, why is it marked 72.4 at the bottom for calculated quality rating and 87 at the top of the sheet for quality? And I can explain it real quickly. This 72.4 is a raw score, and when that raw score is converted to percentiles, the percentile is shown up at top at the quality rating itself. So a raw score of 72 points puts it in the 87th percentile.
Yeah, in fact,
we also have a hand up from Kathy. Kathy, you're unmuted. Go ahead. Okay, evidently Kathy did not want to speak, so I'm going to put her back on mute. And Mark, why don't we let Matt continue with his presentation?
Absolutely, and we can come back to questions along these lines too later. All right, let's go ahead and press on. Matt's going to cover the company Altisource Portfolio Solutions.
And keep track of which Altisource it is, because it could get confusing.
Yes.
So let's go to the next slide. So before we talk about what Altisource is, I'll just mention, as Mark and Ken have, how did I find this? As with my selection from last July, AZZ, I find that I like to hang out in dangerous territory. That's why I have the black diamond on this screen.
You and Hugh.
But it's one black diamond, not two, because I do still look, although I want to see the whole list, I still want to look at companies that are high quality. So this is actually the very top of the par list. I put in as a search criteria just a minimum of 15%, and you see Altisource is number 5. Now I very quickly ignore items like Dendrion. Dendrion is just a quality of 2, barely measurable, and a projected PE of 50, which is quite rare to sustain, and in this case they're not even achieving it. Likewise, I'm not looking at Corinthian colleges, which actually is a quality of 0, the very bottom, and then even though it has a high par, is only looking to sustain a PE of 6. So there's some significant things wrong with both those two. When I look next at Altisource, I really like to look at high-quality companies that have a high par, but are only doing that by achieving a moderate projected PE, so PE of 13. Not too high, not too low. So there is something interesting, in my words, or my feelings here, something wrong that we might be able to take advantage of and buy this at a very low price. You can see on this list too, going down just a little bit, we have Tango, which can be an interesting study. You have Universal Display, which we've seen in several screens around here, not too far away. And a little bit further down, Yandex would all be items, although here Yandex is a very high PE. This is beta data, so it wasn't that bad in the other screens. But as high-quality companies, somewhat a higher PE, but not skyrocketing like 50. Those all could be interesting things to look at if you're ready to be a little bit more dangerous. Okay, so Altisource is a company. It does business in the U.S., but its headquarters is in Luxembourg, as many of us are learning more. That's for tax reasons. But it does have an international staff as well. So even though the business is focused in the U.S., they execute around the world. It has 9,000 employees. This is as of their second quarter 2014 update, and just about $1 billion in business. Let's go to the next slide. Now, if you're going to understand Altisource at all, you have to start with understanding Ocwen. Ocwen Financial is one of the largest financial companies now focusing solely on subprime mortgages. Yes, if we can't have a sin stock of gambling, let's talk subprime mortgages.
You guys are piling it on.
Yeah, well, the market is pretty high, so you have to look in interesting places. And you can go ahead and click another couple there, Mark. So in August 2009, Ocwen spun out Altisource. It's now Altisource Portfolio Solutions. And then in 2012, they spun out HLSS, Home Loan Servicing Solutions. Shortly afterward, Altisource spun out two other Altisources, Altisource Residential Corporation and Altisource Asset Management. So Ocwen is the lender for a company. That would be the person that you would go to get your subprime mortgage and would generally be viewed as the servicer, so the person handling the money. Altisource Portfolio Solutions is, in their words, a marketplace. So they do outsourcing services. They handle certain functions, as well as they have a software platform to help people manage mortgage-related, or really more broadly, real estate-related businesses. HLSS and Altisource Residential are financial companies that actually hold mortgages. So that would be like the financing companies behind the lender. And then Altisource Asset Management is a focused outsourcer that provides asset management services primarily for Altisource Residential. So there are a number of pieces. All of these could be interesting. You know, one of the things that makes Ocwen unique is you probably haven't heard of them. There are no Ocwen retail bank branches for you to open a checking account or savings account. There is no Ocwen investment bank to help manage IPOs. So they've played a pretty unique position in the cleanup of all the portfolios of subprime mortgages of all the big banks, because they don't have that public persona to deal with what is an ugly part of the financial landscape, particularly after 2008. So let's go ahead. So another just quick couple slides. These slides are from the Altisource investor presentation, which was in last December. There are a lot more slides that describe not just Altisource Portfolio Solutions, but all 5 of those related companies, so you can understand what pieces they do and don't do. Important here on the bottom is to see the marketplaces they deal in. So they are not just interested in the mortgaging. They're looking at the home sales, both buying side and selling side. Home rentals, that's very specifically rentals of single-family homes, and then home maintenance. They actually, you could be a customer of Altisource, and they would help you find people who could help maintain your home. So, for instance, perhaps if you had a vacation home that was remote from your primary home, they could help you manage it when you're not there. As well as they have the marketplace, their software platform to help with originations, everything that you have to do to get the mortgage started, and then servicing through the life cycle of the mortgage. Next slide. So this is a breakdown. Those are the markets they deal in. These are the kinds of tasks that Altisource can do, from finding vendors, processing orders, looking at compliance to regulations, because the regulatory environment, particularly for subprime mortgages, has become a lot more stringent since 2008. And then on the right-hand side, invoicing, collections, professional word, I guess, for things like foreclosing on mortgages or following up on bill payment, and then very simply document management. One of the hardest things that has made recovering from the securitized mortgages difficult is the very long document trail and the difficulty in figuring out who exactly owned which mortgages to approve things like short sales, things like that. Okay, so Altisource has 3 lines of business. This first one is the mortgage services business. Again, this is just under half of the company, their biggest area. This was the area that really they had as primary focus when they spun out of Aquan as well. You can see from the lower left, it's the cash cow as well. Very strong operating margins north of 40. The operating margin was impacted in 2013 as a result of some additional regulatory compliance, which when you're the servicing group becomes more work for you, more cost, without getting more money, but they'll deal with it. And then in the lower right pie chart, again, you can see some of the breakup of what exactly they're doing. When they're, you can see residential property valuation, so actually getting, going out and getting a survey of the properties, asset management, closing and insurance services is an important one, that sort of thing. Next slide. The next business line is financial services. So again, we have on the lower right the pie chart. So the blue is the very friendly sounding asset recovery management, which is again is really foreclosing, short sales, dealing with mortgages that are in default. And then on the right, more generally, customer relationship management. So just working with customers, whether they're paying or not. You can see on the lower left, this had been a growing segment, which is really just coming into its own in 2013 and now 2014, with healthy margins that are now helping add to the company as opposed to investing with very low margins. Next slide. The final area is technology services. So you see in the pie chart in the lower right, they have a platform called RealSuite. So RealSuite is a focused enterprise tool for realty-based businesses. That may be realtors, that may be investors, that may be property managers, or like Aquan, it may be lenders. So it's somewhat like SAP or Oracle running a whole company, but it's more of a niche, whereas you have Salesforce.com or Workday, who focuses on HR. They focus on a particular function of a company. RealSuite focuses on a particular type of company or vertical. You can see it had good margins in the lower right, or lower left, sorry, when it first spun out, 2009, 2010. The margins have gone down, still fairly healthy, not as good as the other segments, but specifically because they're investing. And by investing, they are actually acquiring companies as well as developing software to really set the software platform for other people to use as a growth engine for the company going forward. So there are 2 ways that you can grow revenue in general. And the first way is you can add services to your existing customers. And I like this slide. I like pulling it out because you can see that the company hasn't stood still. So the green blocks at the bottom of each of these columns represent the businesses that they had when they spun off from Aquan. And you can see that every year they have a new class of services which they add to their platform as well as adding to their outsourcing business to offer more to the customers they already have. Obviously, the other way that you can grow is by adding customers to your lines of business as well. Next slide. So again, you can't know Altisource without knowing Aquan. And this chart, I have a little a secondary view of this chart. The primary view of the chart might be depressing, but when you think of non-performing loans or how bad subprime loans were, this chart really tells a sobering story. The Y scale in this chart is the percentage of loans that are delinquent by portfolio, and these portfolios are different portfolios from different banks that Aquan has purchased over the years. But the 2 points from here is one that Aquan is, if you will, the best of a bad lot. So the idea that their loans perform better than everyone else's, which means that if they can get the other portfolios to perform nearly as well as their own, that's a way to make money. And then you can see that Aquan is continuing to grow by buying out portfolios from other banks. And a lot of these names aren't very recognizable because they were only temporary when you bought it out. You can certainly see Chase there as probably the highest non-performing loan when they came in 2012. But certainly, and this isn't necessarily all of JP Morgan's Chase's book of business, but a certain chunk of business that Chase no longer wanted that they're selling at a bargain rate to Aquan, which helps them grow. So again, still looking at Aquin, but one of the things here, and you may think hundreds of thousands is a drop in the bucket compared to the millions of people who have these types of loans. But one of the things is not only is Aquin doing the most refinancing, whether supported by the government with the HAMP program or working directly, but it's also disproportional, right? So they are smaller than these other banks, even in their book of mortgage business. But because Aquin is buying at a bargain rate, they are actually motivated. Their goal is to get to what they want is a permanent, a real mortgage. So someone with a rate that they can pay, and they're going to pay it all the way through the term of the mortgage. It's very different than the goals of the other banks who are really just trying to bury the evidence, get rid of this business, which has turned out to be very bad for them. So why is it so cheap? There are a number of red flags here, and I have them in 3 categories. So first of all is that the New York Department of Financial Services, so a regulator for this group, this is not a bank, but this is a financial services company, Aquin and Altisource, has clashed with Aquin. In February of this year, they actually blocked Aquin from buying about $39 billion worth of mortgage business from Wells Fargo. So that is crimping their growth. In addition, that same office has also questioned really the prices that Aquin uses when they engage services from all these related companies. Now, if this was one company altogether, that would be opaque. It wouldn't be an issue, and every bank has an insurance department, a financing department, all those things. Now that they're separate, though, they're exposed and there are questions being asked. Also, what doesn't help things is that on August 19th, again, this is Aquin, not Altisource, has had issued, actually it was their auditor issued a finding that they need to restate earnings from 2013 to 2014. And it's a pretty arcane bit, but it was a matter of valuation of some business they had. Again, this is well after the spin-off of Altisource from Aquin, but anything with a parent and with a major customer becomes bad news for all. Well, 1.2. So finally, at the end, they are actually announced during all this, during their second quarter earnings call, they announced they were going to do a $200 million stock buyback. Now, this is on a business with a market cap of $2 billion, so about 10%. Why this might be a red flag as well is because this is debt financed, and we'll see in Section 2 of the SSG, this company does have debt as if it's a financial company. So it's very young, but it's buying back very significant amounts of its stock, which plays funny things with its owner's equity. But it can service the debt quite well. So whether you see it as positive or negative depends on your viewpoint of the finances, but it becomes an opportunity because with a depressed price, that really hasn't been acknowledged. Okay, Mark. So looking at the SSG, Section 1, you can see certainly sales is very straight, but generally up straight and parallel. Earnings a little bit variable, but again, and although we only have history to 2008, which was really the last year before it was spun off, being a company that deals with subprime mortgages, it's been counter-cyclical. It's been harvesting the economic issues that were generated. Now, there are very few financial analysts that follow this company. That was a risk that was stated earlier today. And those analysts are actually expecting flat sales from 2014 to 2015 and only 20% earnings growth in the same time. So they're predicting a large deceleration as the number of subprime mortgages to be harvested reduces, and while the company is transitioning to the broader mortgage market, needing to get new customers for that. Okay. Looking at the back side, we can see very good pre-tax profit on sales. Now it says even, so 2012 again was kind of the peak year. 2013 has been impacted in the mortgage services area by the increased regulation, and in the technological services area by a number of investments that were made. Return on equity is up and is very high. Now again, you think it would be very high. It needs to be very high because of the leverage they have. The percent debt to equity is certainly far above what better investing or what most people would say would be a good thing. it might be indicative of a financial company, but again, I would have anyone that looks at this look at the shareholders' equity and the impact of the substantial buybacks they've already done as the explanation for this. Looking at another measure, for example, with the current debt they have, their current ratio, so their ability to handle the interest on the debt, is 1.98, is quite comfortable. Looking at the relative PEs, so one nice thing is that the high PE has been increasing over the years, so from something in the high teens, 2009 to 2011, into high 20s or even low 30s. Low PEs have been pretty steady, somewhere around 10. The current PE is around 14. So where I see the value in this, again, is a company priced like it's going to grow 10 to 14%, really growing 20%, and with a near-term kicker of a significant stock buyback to boost our immediate purchase price. Now, there's one other thing if you're going to investigate this, particularly if you're going to look at manifest, and Mark and I were chatting about this earlier. You may have noticed the first screen that I used when I did the stock screen had a little bit different look, and for those that haven't looked at the beta version, that's Manifest 3.0, and I had to go back there because Mark changed his valuation on me before I got my screenshots, but after I started looking at the company, and that makes all the difference. Actually, if you hit an enter, a couple enters actually, Mark, that'll show up a couple things too. I highlighted a few things. There you go.
Yep.
Oops.
One too far.
So what happened here on the left-hand side, even though it says book value is the way it's valuing it, that's actually the number that was valued based on revenue and earnings, if you will, like a normal company. On the right-hand side, what is now in manifest is it's being valued very much like a financial or asset management company, which is by book value. My assertion would be that since this is really a software company and an outsourcing services company, that the former way of valuing would be the right way. But again, thinking about this as a member of the Aquin family, even though they're not related anymore, it's a spin-off. You know, there are a lot of investors, and you can really understand the market price, who are going to still value it this way, like all the companies it's related to. So I'll say in closing, if I was doing this for Better Investing Magazine, I would nominate Altisource Portfolio Solutions both as my stock to study and my undervalued stock. I think that there are some near-term things. Obviously, there's regulatory risk, but with the buyback, there can be a good juicing back to the levels in 2014. But then looking at the SSG, if they do manage to grow into the general mortgage market outside of just the subprime market and continue their growth, it's an excellent opportunity as well.
Good stuff. Well, thanks, Matt. And we're actually, this is a great illustration of every once in a while you run into a company where you really wrestle with, you know, where does it belong? And sometimes value line isn't the most helpful when they classify companies. And we have to really take a look at what is it. You know, Matt's discussion here tonight has persuaded me that this is more like some kind of a services company. You know, maybe more along the lines of, as he said earlier, a Genpact or a Ebix. It doesn't belong over here. I will tell you that the other thing that this drives home for me is my first recollection of this company or awareness of this company is like 4 or 5 years old, and I was very impressed with the way this company was getting in and getting its hands dirty, protecting the value of basically foreclosed properties. That's one of the things that they were doing back then. It's a small fraction of what they're doing now, but a lot of times banks will let properties deteriorate. These guys were basically attempting to get in and extract value from that, and they were doing it very well. I mean, as they appear to do many things well. But it's just a reminder that these companies can evolve and transform over time, and you really do have to pay attention. I think you'll see this company in some type of a services classification soon. So thanks, Matt.
Sure, Mark. And again, my point is not to pick on you, because it does take a lot of work to figure it out. But think about the whole market investing in this company, and if we're confused or we might see different ways to view it, everyone is, and that can bring about a mispricing.
Absolutely. I mean, I can tell stories till the cows come home about companies like Qualcomm in the 1990s when the market could not figure out that company. And what a tremendous opportunity it presented for many of us. because we couldn't figure it out either, but at least we were coming along and trying. Let's go ahead and close down discussion on Altisource. It's a fascinating company. It's one that you're probably going to hear more about, but I believe Ken has actually constructed a poll for tonight's stocks that were added to the tracking portfolio, and we'll seek an audience vote.
I sure have, and let me get that poll open real quick.
I think these are some fascinating companies to look at.
And I've launched the poll. Folks, all you have to do is click one of the four or choose none of the above, and we'll see which company people are interested in adding as the audience choice. I'm going to try to keep this open while we're holding the poll. We were asked earlier what our attendance was this evening, and we hit a high of 138 people this evening. That's a little bit lower than we've been experiencing, but we think it's pretty good for a lazy summer evening in August. We hope that we'll be back on track to break 200 again once we hit September. Mark, we're also getting some mail from our friends in Washington that would like us to set up a program, a face-to-face program in Washington. So maybe you and I can talk about that tomorrow and get back with Linda Hunt while she still has some, she'd like to get her publicity begun, and she wants to feature your beautiful face and my not-so-beautiful face on the front cover of her newsletter. So,
she didn't say that.
Well, she said she wanted to put our pictures on the newsletter.
Yeah, you're embellishing. Yeah. And again, I can't see the voting results, but I suspect that many of you out there are going to be gun-shy about Altisource, but what a fascinating company to study, especially if you're...
we have 90% voting now, and I'm going to close the polls, and I'm going to share the results. And we had an absolute majority here for Las Vegas Sands. So I was afraid we'd have a lot of people that would veer away from gambling in casinos, but maybe it's a more aggressive audience than I anticipated. So we'll add another holding of Las Vegas Sands to the tracking portfolio. Let me now go back to the regular screen, hide that, and Mark, we should be, there we go. We're running a little bit late. We will stay to answer some of your questions, but for those of you that don't like to leave until we actually close the doors, we will be around for an extra few minutes. Our September roundtable is coming up. Mark and I are going to be traveling live to Indianapolis, Indiana. Mark will be in Lansing, Michigan. Mark and I together in Dallas, Mark by himself in Seattle, and we have other destinations in the works right now. So if you're in any of those cities or nearby any of those cities, if you go to the Manifest Investing website, you can find the dates and the times, and we'd be glad to see you face-to-face and talk with you and answer your questions. So, Mark, do you have anything else to add besides a great big thank you to Matt?
Absolutely. Thanks to both of you. Great presentations, guys.